let's have an example on single entry and incomplete records. B&C maintains his books under single entry accounting. He has provided the following list of balances as at June 30th, 2023. So this is the cash book. They've given it to us and they've given us the closing balance, meaning we do not need to prepare a cash book in our workings, because the major reason for preparing the cash book is to determine this closing balance. But since we already have it, it means that we won't need to prepare the cash book. Then we have the particulars of the assets and liabilities were as follows. We have on 30th June 2022, their year runs from June to June, you get. So 30th June 2022 was the beginning of their financial year, then 30th June 2023 was the end of the financial year. So these are the opening balances, these are the closing balances. Yeah. So in this one we do not have the opening capital, so it means that we shall need the statement of affairs to determine the opening capital. Then we have the additional information, that is it. Then required, we are required to prepare the statement of profit or loss for B&C, and then a statement of financial position as at June 30th, 2023. So we are going to start with statement of profit or loss. So B&C's statement of profit or loss for the year ended 30th June 2023. That is it. So in the income statement, okay, we are going to have 3 columns. Okay, 2. Let's have 2. UGX, 3 zeros. Then UGX, 3 zeros. So we already start with sales. So sales, look at our question. They've given us here cash sales in the cash book. They are these ones. So we have the cash sales. Remember the formula for sales, it's cash sales plus credit sales. So this 972,000. That we can add here another one, dx zeros. Yeah, then we have cash sales. Then here we have trade receivables. We also have bills receivables. They are all like credit sales, bills receivables and then trade receivables. So when you say trade receivables or receivables anywhere, just know that you have credit sales in the question, but it was not given, meaning you are going to determine it, and you determine it by preparing the trade receivables control account. Then we shall also prepare the bills receivables control account. Yeah, so we first prepare that account before we proceed. So trade receivables, control account. We looked at the formatting in one of the videos. So debit, then credit. We said it has a normal debit balance. So the balance brought down, or the opening balance, is always on the debit side. So this is our question. These are the opening balances, these are the closing balances. So this is the opening balance for trade receivables, 240. So 240,000. Then on this side we record things like the money that is received from debtors, any bad debts, any return inwards, any discount that is allowed, things like that, and the closing balance. So what we record on the credit side. So in this question we have collections from debtors. We put it on the credit side because it's reducing on the money that is being demanded from the debtors. So collections from debtors is 768. They are in 3 zeros. We do not have bad debts or return inwards and things like that. So it means that we are just going to record the closing balance. And we have the closing balance here. This is the opening balance, this is the closing balance. And we said if the opening balance is this side, closing balance will be this side. So balance carried down is going to be this, the 280,000. So 280,000. So then we balance which side is greater. This side is greater than this side. So we add 768 plus 280,000, 1,048,000. So we put the greater figure on both sides. So this minus this, the difference you get is the credit sales. So minus 240,000. So the credit sales is 808, like that. So we come in our income statement. We are dealing with sales. The cash ones are those ones. Then the credit, we have 808, like that. Then we also have the ones for bills. So we prepare the bills receivables account. It has the same formatting as the bills receivables account. So we debit and then credit. It has a normal debit balance. So balance brought down will be on the debit side. Bills receivable, this is its opening balance, this is the closing balance. So the opening balance, it will be 80,000. Then the closing balance will be on the opposite side, balance carried down. It is 24,000, is it? This to this, this to that, this to that, this to that. It is 100,000. Then do we have any collections? Yes, we have collections from bills receivables. Put it on the credit side, 240. So collections of 240. Then we balance this plus this. This is 100,000 plus 240, it is 340,000. So 340,000 minus 80, what you get is the credit sales, but for bills. So 340 minus 80, what you get is 280. 280, sorry, 260. Yeah, 260. So we come to our income statement. We write bills. It is 260. So when we add these, we get the total sales. So that plus 972 plus 260,000. That is the sales. So we write it here 204. It is the figure for sales. Then we less cost of sales. We less cost of sales. What do we have under cost of sales? We have opening stock or opening inventory. Opening inventory. Opening inventory is here we have inventory. This is the opening, this is the closing. So this is our opening inventory, 374,000. Then we add purchases. We add the purchases. So purchases, we have cash purchases here, which is 40,000. So purchases, we have those ones in cash, which is 40,000. Then we have the trade payables and then the bills payables, meaning that we have the credit purchases and they were not given, so we are going to determine them. We are going to prepare the trade payables control account to determine the credit purchases. Then we also have those in terms of bills, so we shall have the bills payables account. Like that. So these ones, the payables are liabilities, meaning they have a normal credit balance. So the opening balance will be on the credit side. So balance brought down. Even here, the opening balance will be on the credit side. Balance brought down will be on the credit side. So according to our question, trade payables opening balance is 180. So it is 180,000. Then closing balance is 30. So when the opening balance is this side, closing balance will be this side. So balance carried down is 30,000. Remember, this account is in UGX, 3 zeros. Even this is in UGX, 3 zeros. So we also have the trade payables that were paid during the year, so they will be on the debit side. We write bank. It can be cash or bank because it was not specified whether it is cash or bank. Yeah, but if it's specified, you put what was specified, bank or cash. But here we are not sure, so it was what, 542,000, like that. So we add we balance which side is greater. This side is greater than this side, so this is going to be 572, like that, 572, then this minus that, 572,000 minus 180,000, 392 will be the credit purchases. Then for the bills payable, we do the same thing.